Good evening, everyone, and thank you so much for having me here. I hope you're all enjoying the snacks and extremely looking forward to speaking with you guys this evening. So my name is Thrinayani, and I am delighted to be speaking as part of the LSE Statistics Insight Seminar Series. We are living on such a fast-changing planet in every sense of the way, so technologically, socially, and economically as well. And from shifting geopolitics to the rise of agentic AI really impacting businesses, this is transforming how organizations operate, and that pace of change is accelerating everywhere that we look. But one priority has always remained constant, and that is the need to be sustainable and to act in a sustainable way in the communities that we serve and in the firms that we work for. And in that context today the role of the actuary has never been more important. So Frank Reddington, as you may know, one of the legends of our profession, once said that an actuary who is just an actuary is not an actuary at all. And I think that quote has never felt more important or relevant, because the actuary of today and tomorrow needs to evolve with a more diverse skill set and really put those technical skills into practice by being involved with stats and strategy and be leaders in sustainability. So your group as the future are really going to play a crucial role in shaping our sustainable futures. So in this session, I'm really excited to show you about the various skills that you can hone and develop within the field of stats, in modelling, and risk, which is now shaping the way we sort of take risks and decisions as well in business, and developing stronger firms and businesses as a result. So the topics that we're going to cover today are the following. So we're going to explore how actuarial thinking, stats and data science is central to addressing sustainability challenges. Very interestingly, a report by the World Economic Forum have found that by 2050, climate change is likely to have caused an additional 14.5 million deaths, and that equates to around 12.5 trillion in economic losses worldwide, showing that these risks need professionals such as actuaries who can quantify uncertainty, model long-term outcomes, and communicate risk responsibly. We're also going to explore how climate, nature, and systemic risks are reshaping the field of finance. The Network for Greening the Financial System estimate that up to 13% of global GDP could be at risk by 2050 and under severe climate pathways. We're also going to explain why both quantitative and tech skills are critical in this field, because the OECD actually estimates that over 1.3 billion jobs worldwide are going to be transformed by tech in the coming years. The International Labour Organization and the IFOA have both highlighted that green and sustainable finance roles are one of the fastest growing specialist fields in the financial sector. And I'm also going to provide some examples of the technical insights and the skills and the career pathways that are going to be available, and really show how your skills can help to solve these challenges whilst you build careers that are going to be long-lasting in the future as well, and future-proof. So, just to talk a little bit about the behind the scenes of my career journey. So one message that I would really like to express to you is careers aren't linear and actuarial work is so diverse. So I began my career in pensions actuarial consulting, working on DB pension schemes and the valuation of those, and really communicating the results to pension trustees who really hold the futures of these schemes. And working in pensions gave me a really strong appreciation of business advisory and valuing the funding position of the scheme, whether it's in a deficit or a surplus. And from there, I moved into life insurance, working for a business that wrote annuities and equity release mortgages, which are products designed to release home equity in later life. ERMs involve risks in property, longevity, and interest rate modelling, and behavioural uncertainty as well, because you never know how lapses are going to be forecasted into the future, which meant applying a blend of actuarial skills. During this period, I also worked on a real-world merger and acquisition, where the company that I worked for was acquired by a multinational reinsurance company. And this really helped me gain exposure of bid assessment, how do we actually assess insurers, and Part 7 sort of transfers, which involve the legal transfer of annuities from one business onto another, which is sort of in between firms as well. And this gave me a really deeper understanding of how capital and legal structures and risk management actually work in practice. So after that, I moved into actuarial consulting, working at a global advisory firm, working on actuarial assurance engagements for the largest UK insurers and mutuals as well. And this meant really independently assessing the actuarial reserves within reporting frameworks and deadlines for investors and for regulators as well. So currently I work in health insurance, actuarial sector, focusing on strategy, on marketing and analytics. So my role involves analysing thought leadership on UK health and protection market, and really crafting the marketing messages to help maintain a competitive position within the insurance field as well, while supporting various functions within the business. So for the past 5 years, I've also served on the IFOA board on sustainability, and I'm now the current vice chair. So the main skills I've been able to pick up are actuarial thinking, communication, and really that hunger to keep learning, keep adapting. And your degrees are going to place you in such good stead to keep practically applying your learnings and find out what really works for you and what you're interested in and your preferred areas in practice as well. So what do we actually mean when we talk about sustainability in finance? So firstly, we talk about long-term value creation under uncertainty. So this really means that financial institutions such as insurers, pension funds or banks will need to continue to meet their obligations decades into the future, whilst ensuring good outcomes for customers and for broader sort of our communities and society as well. In life and health insurance, one of the biggest uncertainties is human health. And the World Health Organization state that up to 80% of heart attack, strokes, and type 2 sort of cases in diabetes can be prevented with behavior change that can be modified. But real-world behavior is so complex and unpredictable, and this needs to be allowed for within risk models. Sustainability also means recognizing that climate risk is now the main sort of risk that we are handling at the moment, and major UK insurers now regularly run climate scenario analysis. And they use frameworks such as Network for Greening the Financial System, NGFS, which we'll speak about a bit later, and the IPCC climate pathways. So many of this modelling is driven by regulation, including the TCFD reporting, which stands for Task Force for Climate-Related Financial Disclosures, and guidance from the Bank of England's PRA, who are the prudential sort of regulation authority. So the goal is to assess how climate transitions and policy shifts are affecting insurance liabilities and asset portfolios over the next 10 to 50 sort of plus years and beyond. Sustainability also includes nature risk, and the World Economic Forum estimate that over 50% of global GDP is highly dependent on nature. And this is huge because insurers and pension funds need to model these nature-linked risks so they can remain resilient and still ensure that they can pay their obligated claims well into the future. So I'll touch a little bit about the sustainability research that's shaping our field and in the profession. So on the Sustainability Board, we operate various portfolios such as communities, education, and research. And the research portfolio is really key to bring that up-and-coming research out there for our members. So we are advancing research across the biodiversity sphere, demographics, insurability, investment net zero transition risks, and reporting, whilst also ensuring that actuaries, regardless of the field that they're in, have oversight over this and can implement it in some way in their work. And really highlighting the evolving risks in this landscape. In addition to all these, the IFOA research have pioneered a term called Planetary solvency, and I'm really excited to explain about what this actually means coming up next. So, what is planetary solvency? So this is a key area shaping the actuarial field as it is today, and really introduces a very powerful idea, which is that just as you think about solvency that ensures that firms can meet their liabilities, planetary solvency essentially ensures that the Earth's system can continue to support us and can continue to support sort of economics and prosperity. The research really shows that climate change and the biodiversity loss and resource stresses are essentially systemic financial risks affecting a lot of things over inflation, markets, insurance, and pensions as well. So the reports, I've linked the two reports there. The Parasol Lost is actually a very recent report that was published only last month. And this builds on this concept and really shows how climate risks cascade through the financial system at the same time, impacting asset values, credit risk, and insurance losses as well. It also highlights that geoengineering could be used as a potential response to climate failure, but it really warns that this could introduce a whole host of new uncertainties, worldwide tensions, and really unknown side effects to weather systems. So for actuaries, our role is really expanding from only just pricing risks to helping organizations become more resilient and to really embed climate scenarios into their capital models and to plan for major upcoming unknown risks into the future. So over the years, climate risk reporting for firms has grown increasingly complex. So we as actuaries need to constantly upskill and manage teams effectively to execute and finalise the timely reporting of climate risks for greater public and investor confidence. So at the heart of this shift is the ISSB, which stands for the International Sustainability Standards Board, who are really working to create a consistent global baseline for sustainability and reporting. So these standards that are built from and on the Task Force for Climate-Related Financial Disclosures, which many large firms are mandated and really have to report against. Alongside these global standards, there are also frameworks such as the PCAF, which stands for the Partnership for Carbon Accounting Financials, who are really helping organisations to measure their impact from financed emissions much more consistently across the board. And also, the UK government is set to publish the Sustainability Reporting Standards, or the SRS, this year to really strengthen disclosure requirements and to tackle reports of greenwashing, which are essentially firms highlighting claims which could be untrue. So what this means is that sustainability reporting is really moving from subjectivity to actually metrics that can be audited, where actuaries have a very unique opportunity to lead and translate complex climate risks and support a much smoother net zero sort of move for a lot of firms. So now that we've explored what sustainability means, I'm really excited to delve a bit deeper into broadly the actuarial field and profession, and how and what sustainability considerations are key across each of the sectors. The important point to emphasize is that sustainability is increasingly part of everyday actuarial work and is also becoming a specialist career pathway in its own right. So in many roles such as health, pensions, life, non-life insurance, reinsurance, and in banking, sustainability is now embedded in the way that we practice risk management, modeling projections. And we're currently also seeing more of a shift in more sustainability-focused actuarial roles in particular, especially, for example, net zero transition planning and green finance, which are only really spaces that have really evolved over the past 10 plus years. So in this section of the talk, I'm going to focus on the fact that whichever career path or field which you choose to practice in, learning about the relevant sustainability risks and actuarial training is really going to help you support this new way of thinking. So let's firstly explore pensions. Actuaries are taking on such a fast expanding role in helping pension schemes understand and manage their climate-related risks. IFOA research has also interestingly found that climate analysis is now embedded across pensions work, including on the valuation side and employer covenant assessments, which is essentially focused on the strength of the governance of a pension scheme by its employer. Climate risks are shaping the way that we make choices about our pensions, both from an individual and employer side as well. So when employers, if and when employers plan to sell their DB schemes to insurers, which is often called a buyout, trustees assess insurers on their climate frameworks and the credibility of their net zero claims, which often determines which insurers will ultimately win these multi-million-pound contracts. Increasingly, we're seeing an influx of climate default DC pension funds, which link to climate mandates that are given to asset managers and net zero maps as well. Socially responsible investing, or SRI, is now a key part of the strategy for major pension funds, with global sustainable assets reaching around 35.3 trillion in terms of dollars, representing that shift towards responsible finance. An example of SRI in practice is the Rail pension scheme, who are investing in infrastructure that is aligned to the UN goals on sustainable on development as well, the SDGs. So, regarding sustainability considerations in life insurance, the insurance industry leaders have warned us that a 4-degree world may become completely uninsurable, which is absolutely huge. So insurers need to be the ones to pioneer strategies in a sustainable way. In life insurance, sustainability directly affects risk, pricing, reserving, and long-term resilience of portfolios. Life insurers are also making sure that they adhere to net zero targets as major institutional investors by divesting from high-emitting sectors and increased focus on renewable energy and green energy infrastructures. For insurers, higher mortality also means a greater uncertainty in long-term actuarial assumptions and less predictable CMI, which is the continuous mortality investigation, and model projections over time. The very young, elderly, and the low-income families are the most vulnerable to either thermoregulation or less access to healthier and safer environments, which also impact. Regulatory pressures to report TCFD for large insurers and the PRA guidance and the NGFS scenarios, they all call for insurers to adopt sustainability expertise and to be seen as industry leaders. So just to touch on how actuaries can actually apply scenario analysis in practice. This scenario analysis is applied in deep uncertainty. So for insurers, this can mean evaluating their resilience through their ORSA, which stands for Own Risk and Solvency Assessments. And for pension schemes, these scenarios really allow actuaries to assess long-term asset returns, funding ratios, and their asset allocations as well. The NGFS scenarios are powered by 3 global and major integrated assessment models. And these models essentially combine climate science and modelling to allow actuaries to test how their portfolios can behave under different climate futures. So an orderly transition is essentially one where the policy action is really early and smooth, and everyone takes a coordinated action towards net zero. But in reality, we know that this may not always be the truth. So other sort of pathways are present as well. A disorderly transition means that policy action arrives often too late and is more disruptive. And hothouse world scenarios are where physical climate change is the prominent one. These hothouse world scenarios involve much higher physical risk, such as storms, drought, and economic damage, but initially lower risk to get to that place and transition. All of these are built on shared socioeconomic pathways where the population peaks around 2070 and the world's economy continues to grow unless climate impacts intervene. The NGFS framework is also evolving with more scenarios being added over time, and that model in that demand in energy, and also an outcome which is called that actuaries have done, or people in this field have done a lot, but in the least amount of time, which may not be the most impactful or influential. So, moving on to the considerations within health insurance, the World Health Organization have stated that climate change poses a significant threat to future mortality and morbidity, even under scenarios which could be deemed optimistic. Air pollution worsens respiratory and heart health, and also zoonotic diseases like pandemics actually emerge from loss of nature. The WHO have also provided guidance for developing climate-resilient healthcare spaces to make sure that these areas can withstand climate crises while continuing to provide care which is of good quality. The health of our planet is so deeply connected to our own human health. So, to give you an example, more than 60% of cancer treatment drugs are derived from nature, plants, and marine organisms, which need the protection from extreme conditions caused by climate change. Working in health insurance actuarial in marketing strategy has really allowed me to learn how insurers are increasingly using health insights to champion earlier an earlier way that we can know illnesses in the human body. And the sustainability, so the benefits of having members as insurers who are healthier are that over time they usually have lower long-term claims and are more engaged customers, leading to improved sort of health insurance, which impacts both the customers in a positive way and society as well. So a useful global perspective comes from the UN Environment Programme Finance Initiative's report, which is called Health is Our Greatest Wealth. And this report really highlights that health, environment, and financial our financial world are so highly interconnected. It shows that closing the protection gap is essentially about investing in prevention and healthier lifestyles to essentially aid stronger health systems. Insurers are increasingly using incentives to encourage healthier and more sustainable behaviours, from health activity tracking to community rewards. Technology makes all of this possible by enabling measurable health outcomes, which is helping to shift the health industry from being very reactive and only being there for the customer at the point of claim to more proactive risk intervention and prevention. The report also shows, interestingly, 4 key ways that insurers can help to really support this shift, which is essentially engaging the policyholders and communities in care, which helps to stop illnesses at the cause and prevent illnesses, and essentially use tech in a very ethically minded way to expand access. The report also shows that by working with healthcare centres and providers and governments and communities, inclusive health insurances can be developed to essentially reach the populations who are also the most vulnerable as well. This report critically provides the strategies which provides a future where prevention and sustainability go hand in hand and help each other. So in general insurance, there are, the way that sustainability is treated is slightly different, and we'll explore that shift here. So in non-life insurance, personal lines of business, as you know, include coverage against motor or home and contents insurance to protect against those risks which are personal. And commercial lines include business-related insurers, such as indemnity insurances, which are more focused on the business. These lines typically have much shorter horizons compared with life insurance, making the nature of challenges and sustainability a lot different. So in non-life insurance, climate risks have led to the frequency and severity of cat risks and catastrophe risks rising. Warmer oceans fuel rapid storm intensification, and sea level rises are already creating clear sky version of the flooding, which essentially which happens in a very fast way and rapid way. So to put this into a UK context, the Association of Insurers in the UK, the ABI, latest data has revealed that across 2025, insurers have paid out a whopping £1.2 billion in weather-related claims in property, which is a 14% increase from the previous year. And damage to people's homes as a result of storm has resulted in much more over the past year, which was essentially a 32% increase over the previous year. For non-life insurers, this means that higher losses and more demand for reinsurance, essentially to protect their own business. And also, the commercial lines insurance costs have also risen due to new and emerging risks in renewables. So failure to manage climate risks or misleading ESG reporting can also lead to other risks that we are seeing in this field. And just to link this to the climate risk modelling that's usually undertaken in the sphere, at a global level, what insurers wish to do is really anchor their climate modelling to establish frameworks which are developed by the bodies such as NGFS, Network for Greening the Financial System, and the IPCC, which is the Intergovernmental Panel on Climate Change. These sources effectively set the assumptions that feed into the climate risk models used by insurers. The Bank of England's exercise, which was conducted a few years back, adopted these NGFS scenarios to assess the resilience of major UK insurers and banks under three possible futures. So they adopted an early policy action, delayed action, or no action. And these results have actually showed that firms can experience a 15% erosion of their of their profits on an annual basis under some of these pathways and scenarios. And this really highlights how poor climate information and quality and exposure to carbon-intensive industries can really affect firms. The IPCC AR6 report has provided the shared socioeconomic pathways that really forecast how the world changes years and years into the future. And this is also used by firms to model and project their risks. So in non-life insurance, what we see is these impacts are immediate, as the IPCC states with virtual certainty that at least 2 degrees of warming, a rainfall event that was previously expected 1 in every 10 years, can now become at least 1.8 times more likely to occur. So this means that there's more reliance placed on cat bonds and other products that essentially pay out on specified events, on trigger. For life insurance, climate risk feeds through mortality and assumptions on morbidity as well. More frequent heat stress, climate-linked disease spread, and water insecurities also lead to impacts to life insurances and protection, and also on retirement savings side. So life insurers model how mortality curves and health trends can really shift under different climate ways and their pathways and scenarios as well. So in reinsurance, insurers participate in risk-sharing agreements with reinsurers to protect their future obligations, should this rise unexpectedly in future scenarios. The reinsurance industry, however, is increasingly exposed through sustainability challenges in a slightly different way. They're exposed to more natural cat events, especially via their specialty lines and also within their investments as well. At the same time, investors, regulators, clients, and employees now really expect reinsurers to show leadership on environmental side and on the ESG side, because they are really the guardians in this field and should be seen as being actively acting and promoting on sustainability. So this means that reinsurers are really developing new ways and methods, including climate-driven cat models, human capital, and social to really model social instability risk and other exposures as well. So the key focus areas in reinsurance is increasingly becoming on the parametric insurance products, which are triggered by measurable events to enable fast claims and really support the markets which they support and offer. And many leading reinsurers have actually committed to net zero targets, really enhancing their ESG reporting and aligning and keeping their underwriting within the pathways which they model. So, ESG is a key priority for banks, and there are several ways on how sustainability is considered on the balance sheet of a bank. So first, banks want to look outwards at their clients by evaluating ESG risks within business model from a credit, capital, and perspectives on the profit side as well. So for example, they'll look at their clients and essentially judge whether they hold mortgages in flood-prone areas, meaning higher expected losses, and also whether loans have been provided to utilities companies within sort of coal and carbon-intensive fields that really face transition risks and impairments to their assets over time. Banks also want to sort of look inwards as well at their own impact and also assess how financing new of the projects in carbon-intensive fields can also trigger how they're seen from the outside and also avoid any risks in terms of litigation as well. So this is essentially embedded across the 3 lines of defence, and this is key for banks to really help them to run these climate stress tests and the capital adequacy assessments which they must conduct. So the UNEP-FI's report, which is linked on this slide, also sets out the best practice playbook for banks in terms of how they should set long-term assumptions and also their intermediate assumptions for net zero targets. And this really covers scope 3 emissions and how they can transition as well more sustainably. So to provide an example, a major bank within the report conducted included have conducted a climate scenario analysis on their retail mortgages and commercial estates book across multiple countries and really assessed the ability of the borrowers to repay the property values. And this practically shows how climate modelling is really required and real opportunities for actuaries in areas within banking and sustainability across innovation in products and green mortgages as well. So now there's a very large and specialist actuarial area of sustainability itself, which can really attract actuaries both who are also early in their careers and also those with experience as well. The IFOA's thematic review report on actuarial involvement in sustainability highlights that climate and sustainability work is now present in most of the core actuarial areas. Actuaries are also working across various fields and disciplines in scenario analysis, enterprise risk management, ALM, and climate risk planning and disclosures. Within insurance, actuaries are upskilling in climate-related risks for the ORSA, exposure management, and in CAP modelling. Within pensions and investment, sustainability is emphasised on the funding side and valuation, and on manager assessments as well. Another finding from the report is that a lot of actuaries now sit in senior head of climate and sustainability roles, where there is that extensive opportunity to collaborate across functions and across teams as well. And it's surprisingly reported that more than 80% of organisations are reporting more actuarial involvement in their climate risk work compared to 3-ish years ago, really highlighting the need for actuaries in this field. Using a case study in the biodiversity field, actuaries are increasingly helping clients and stakeholders monitor their nature exposure, and they do this using TNFD, which is the Task Force for Nature-Related Task Force for Nature Guidance. And this really integrates nature risk with climate risk and really preparing them for potential future mandatory reporting on this side. So in terms of career choices, there is now a recognisable profile of a sustainability actuary working on climate scenarios and product design from really a green angle. And the International Actuarial Association have really called for this role to be officially known and sort of more spoken about in the coming years across all member associations as well. So now that we've seen how sustainability plays such a huge role in so many different actuarial sectors and skill sets, in order to manage this challenge, our IFOA board on sustainability really lead how our field responds on a sustainability side. This is done by shaping research, upskilling actuaries, and really embedding sustainability into everyday practice. The board also advises on major government consultations and integrates sustainability into actuarial education, making sure that actuaries from all sectors are ready for the future. So as part of our board, we've also developed a series of resources linked to how the United Nations goals on sustainability links to actuarial field of practice. And it's also a really interesting read, which I would recommend, and it's written via insights over our board, over the board colleagues and myself as well. So have a check out of the resources linked just here for you as well, if you're interested. So just touching on how the board prepares actuaries to take on the challenge of on sustainability side. They do this by really ensuring that climate change is becoming a core part of the actuarial education. So future actuaries need to understand the science behind this to really understand it and integrate this into their models as well. The IFOA's Climate Risk and Sustainability course, linked on this slide, is a good example of this kickstart. The board also shares resources focused on systems thinking, since climate risks are so interconnected. The board also offers tools and education on modelling, and also engages in consultations to really uphold ethics and the core values within this field and in sustainability. So moving on to focus on another section now, I would just like to touch on the key skills for actuarial students in particular to hone in and practice. So all of this work sits on academics, Stats really help us to quantify and communicate uncertainty. Time series and regression methods help us to understand how fast things are changing. So, for example, actuaries use time series models such as ARIMA, GARCH to really analyze historical climate information such as temperatures, rainfall, sea levels, and really forecast future extreme weather events. This also helps in modeling the increasing frequency and severity of natural calamities, which in turn impact on property and also pricing and reserving side as well. Actuaries can also use long-term trends, such as the rising incidence of certain health conditions due to air pollution or heat waves, to really analyse these within insurance claims. So, for example, weather-related accidents in winter. This understanding is really important for adjusting strategies within the actuarial field. Stochastic processes underpin the scenario analysis and capital modelling and stress testing. Actuaries use stochastic models often on the Monte Carlo side and in simulations to project the future solvency of insurance companies and pensions under various conditions. This helps us determine appropriate risk-based capital requirements and ensures that that system can meet the promises due over many years. And by providing a distribution of possible future outcomes, so for example, funding for a pension plan, these models help us to enable better options that we can go for when we're analysing risk inside a business. Stochastic interest rate and mortality models are used to price products which have guarantees in the long term. So, for example, on annuity side as well, and they really help to value liabilities in a market-consistent manner. So this mathematical toolkit used by actuaries is what makes our field so helpful in terms of helping the people that work in our field to translate climate data to this academic base and foundation. So alongside the academic foundations that we've just discussed, actuaries also need the tools to really translate this theory into real-world insights. So Excel and VBA is I've been able to use this most often in my career, used for analysing data in various different fields and in different business functions as well. So Python is also used on the modelling and automation side, R for analysis, and SQL for really extracting and helping to manage large information in sets. So tools on the visualization side really help us to communicate insights with clarity for boards, which is really critical when we're talking about sustainability, climate risk, and long-term uncertainty as well. Profit is a leading actuarial modelling system that allows life insurers to project their liabilities and stress test scenarios way into the future. So an understanding of these tools will really help you in good stead in the future as well. Even though you need licenses to probably access Profit and other tools, it would be a good idea to actually go on the websites themselves, because they do have quite a lot of useful tips and demos to really help with that understanding of how to use the product and how to apply it in real life to various different areas. So it'll help you with a good product understanding of on the unit link side, with profits and annuities as well. So professional skills are really what help set you apart as an actuary. Clear communication is critical, since we translate complex models and uncertainty into messages for high-level boards and regulators, and messages that the public can really understand as well. This type of thinking can really help us to challenge assumptions and really identify where the models that we might build in the future could fail in the long term and help us to adjust, especially when thinking about risks in the climate field. Ethics is really key because our choices influence pricing and pensions as well, and really affecting the public. So we really need to adopt we really need to adopt the ethics and the values that will help us in our work, since we are interacting with the public. Curiosity really helps you learn, and sustainability, as we've just learned about, is applicable in all the fields. And really asking questions in new and emerging ideas as well. So I really would encourage you to engage early with the field and profession. We also have an early careers board on the board on sustainability. So if you're interested to be involved, you can reach out, and whenever opportunities arise, we would actively look to share them as well.